Welcome to Investors Guide. You're watching ET Now. Of course, there's something different about this week. Kumar is with us in the studio in Mumbai as opposed to Delhi. Thank you so much for coming in. It's a pleasure to have you in the studio. Now, for those of you at home who've been writing to us over the last year or so, worried about the performance of certain funds, this week we're going to take a special look at funds that have turned around or seemingly turned around in the last 6 months. We'll tell you what you can expect from these funds going forward and if this turnaround is here to last. Of course, you can grab a pen and paper, write down our email ID or our Twitter accounts and get in touch with us if you need anything at all. On the show this week, first of all, what do the returns of the last 6 months mean? We'll review each of these funds for you. We'll tell you what a claim settlement ratio is for an insurance company and how it's calculated. And finally, we'll tell you how to pick an online term insurance policy. All right, so let me bring in Dhirendra. We've seen a massive turnaround in several equity funds over the last 6 months, and I want to first put that up on the screen for our viewers. HDFC equity up 25% in 6 months. HDFC Top 200 up 20%. HDFC Prudence also up about 21%. And particularly, we know our viewers have been writing in about these funds, writing in about the HDFC group in general from that AMC. Now, when you look at the returns right now, is this the turnaround that all of the viewers were hoping for, or is this just a blip in reaction to what's happening in the market? How do you read what's going on with these funds?
No, one is that, HDFC funds were focused on a segment of the market which was out of favor. They have gained favor right now, and they have gained favor not in a very disproportionate way. So I would say that, this is just regaining some of the lost ground. Investors have something to cheer about, that generally market has gained ground. Some of the laggards, their hypothesis or their basis, because HDFC funds had a portfolio focus and they did not change track based on the state of the market. They stuck to it and now it has proved rewarding, and that is pretty simple. They have been underweight on FMCG. They have been reasonably overweight on, the PSU banks, and that has come in handy. And last year, when we saw this big pullout from India, the whole change of track, and I think a lot of funds were caught unaware. Everybody was expecting that good times will be back, and on the contrary, we saw a real bad time in a fairly unexpected time, and that impacted many other funds which were poised for a takeoff.
Well, when we talk about HDFC in particular, there was almost stubborn conviction on the part of the fund manager to not change course. Now, a lot of our viewers we know have been waiting for this for a very long time. The question they are asking right now is, should we take this 20% as a blessing and exit out of this fund, or does this mean we should stay invested because this 20% is going to grow even further? Can you give us any guarantee that we're not going to find ourselves back in the situation we were in last year?
No, I don't think you should take any of those lessons. I think there is one lesson for one set of investors which is not very uncommon, that I come across investors who are invested in HDFC equity, HDFC Prudence and HDFC Top 200, and they think that they are diversified, but they are actually not. All the funds were guided by the same principle, the same emphasis. And I would say that that sense of diversification and the false sense of diversification that you have is unreal. Use this opportunity to genuinely diversify. If you have all your money in these 3 funds, don't let it be there. Maybe let 40% be there and spread your money elsewhere. I don't think, long-term investors should be exiting from equity right now. If you don't have the time, then by all means, use this as an opportunity. But if you have the time, and then I certainly feel that it's not a time to exit the market.
The other fund house we must talk about is Reliance. Reliance Vision is up 23% in the last 6 months. Reliance Growth is up about 17.5%. Again, funds that customers and viewers were concerned about, they seem to have turned around. What's your call on both of these funds?
These funds, turning around, the turnaround in these 2 funds is much more different. They also have their focus on a set of stocks, which are perhaps the kind of stories which they invented, or they discovered it ahead of others. They were ahead of curve compared to many other funds, and they have stuck to it. Last 3-4 years has been very hostile. At the same time, the weather has been very hostile for Reliance Fund. Reliance as a fund family has been under tremendous pressure, witnessing exodus. So as the popular saying nowadays is that, अच्छे दिन आने वाले, maybe, it's just a beginning of that.
That's the thing. For funds that are so heavily inclined towards mid and small cap, and अच्छे दिन could also mean days of extreme volatility, which we are going to expect over the next month or 2 months. For viewers who are watching right now who are invested in Reliance Vision and Reliance Growth, and they're looking at this 20% saying, okay, I'm up 20% over 6 months, what should they be prepared for in the medium and the short term in terms of volatility?
If you are really going to be bothered about it, worried about it, you should take your money out and never come back to equity. Because what we have seen over the last decade, we have two such occasions when the market went up or down by a magnitude of 15-20%, and if you just got into sleep for a week, you will not even figure out that it happened in between. So look at it like that. I don't think if the market really scales up by 10%, then it will correct, or it will moderate, and you will not feel that difference. What we have seen so far in the last 2.5 months, there has been a big turnaround. That apart, ignore the noise, because bad times, if we see a 10% decline in case of ambiguity, or the result is not on anticipated lines, that also will not be a lasting situation, or that will not be the lasting complexion. And if it goes up, then feel happy about it.
So for viewers who are invested in Reliance Vision and Reliance Growth, be prepared for volatility. If you're not prepared for volatility, you have no business being in these funds at all. And of course, on results day for the election, you're saying do nothing.
Do nothing, and feel happy about it if it goes up, and ignore it if it goes down a bit. Because if you are investing for what you have gone through in Reliance Vision or HDFC Equity, the finest fund, that 8% decline or 4% decline in a day should not be impacting you, because most investors have experienced horrible time in last 1 or 2 years.
If you're talking about mid and small cap funds, I must bring this up. HSBC small cap up 48.98% over 6 months. HSBC mid cap fund up 48.42%. ICICI Prudential mid cap up 40%. Is this just a reaction to the fact that mid caps are rallying in our equity market? Should this give viewers who are watching right now some sort of inclination, okay, mid caps are hot, I should get back in? We know that viewers or investors tend to react in that manner. How should we react to these returns?
No, just feel happy about it, feel relieved. And let me just give you the context to this. HSBC the mid cap fund has just assimilated the small cap fund, which was such a poor performer that it was driven out of activity, and it got merged with HSBC mid cap. And now we have a fund which is the blockbuster, and it is blockbuster because that it also factors in the small cap. If you are into small cap, it will come with a substantial drag in a lean weather. And in good times, they make a comeback. Then there will be blockbuster. They will be so inspiring. They will be so it will be so massive again that nothing else can match it. And that is something which you have to a lesson which every investor should take.
So for those investors now who possibly in that small cap fund very disappointed, now they're seeing some sort of return, should they be taking their money out?
If you're looking to supplement your portfolio with a small cap, then have your boundaries, have your rules. Gain of this much, you will walk away. Loss of this much, you will walk away. Or you will be at least through this for a full market cycle. And I think that market cycle is not over. If anybody has been with the small cap fund for last 6 years, I think the good times are still ahead, because we have been through this only for 2-3 months, and 5 years of treacherous market. I don't think people would have anybody would have broken even on this fund if one has held it for last 5 years.
All right, last one that I have to ask you about, ICICI Prudential mid cap fund up 40%. Again, do the same rules apply as you told us for HSBC mid cap, or is there a difference in the way this fund is performing, and your verdict on it?
No, I would say that this was not a horrible fund. It was an average fund, and it has been an outstanding. It has been able to deliver in a very outstanding return in a brief period of time, or in this run up. If I look at particular overweight, which is construction, I find it amazing that this fund just wasn't there, and it has been able to emphasize that part. And it can backfire. It may not work always, but till some of those rules, it is likely to remain a mid cap fund at all times. Some of these tactical things might materialize very impressively and very disappointingly at some time. So feel happy about this. And it has never been a horrible fund.
All right, it's never been a horrible fund. A quick recap of everything we just talked about. If you're looking at your funds portfolio right now, be happy about the returns that you have. If there's something there that makes you uncomfortable in terms of the risk that you're taking, then you know that you're overextended either in a particular sector or a particular portion of the market, like Dhirendra said, if you diversify, your risk comes down. And of course, if you have any questions about what you just heard, write to us. Email ID is at the bottom of your screen. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. Dhirendra Kumar is still with us in the studio, and we have a question on our hold or sell segment. Jatin Mehta has written in, Dhirendra. He's an NRI. He hopes to move back to India over the next 3 to 6 months. So he's made an investment on the 1st of April, and he sent us a list of the mutual funds that he's been investing in. Now, the thing is that he has a 3 to 6 month horizon, and his list of investments make me very nervous. I'm going to take you through the list that he sent us. He's invested amounts like 25 lakh rupees in the ICICI Prudential Flexible Income, 10 lakh rupees in the iPru Balanced Advantage, 10 lakh rupees in HDFC Short-Term Opportunities. Now, 2 of those are debt funds, but he has SIPs going in Franklin India Prima Plus, iPru Blue Chip Equity, Birla Sun Life Frontline Equity, and a couple of mid-cap funds as well. Now, for someone with a 3 to 6 month horizon, he's put a lot of money in a lot of equity funds. This is exactly the kind of thing you advise viewers not to do. What can he do now? If he pulls the money out, he's going to have to pay short-term capital gains tax. He's going to have to pay an exit load. Should he stay invested for 6 months?
About the fixed income fund, he can well stay there. It is not a desirable thing for a 6 months time frame. You know, he should have been in an ultra short-term bond fund, because with fixed income fund, you could get a nasty surprise anytime. And that has been proven twice in the last 1 year, many times in the last couple of years. So, you know, you really can't get aggressive, and more so when you have to depend, and that sizable amount. And it will be, of course, the scale of decline will be much smaller, but still, with equity, you just can't take chances. And, you know, I'm quite surprised at his understanding that ICICI Prudential Balanced Advantage Fund, it's somewhat like, you know, in this whole framework, the amount of money allocated to this, it is a conservative fund, it is a growth fund, but the point is that it is not a risk-free fund, it is not a fixed income fund. Balanced Advantage Fund is not going to prevent you from a decline when the equity market goes down. You know, the lump sum investment which he has made, which is 10 lakh rupees and 6 lakh rupees in the mid-cap fund, that is the money which he should take out immediately. Because in 3 to 6 months time period, there could be a situation that he can be in substantial losses. In between, he can be in losses. So, and he's very lucky that he has invested the money, and he will be in, he'll be sitting on some meaningful gains on these investments. He can take the gains, pay taxes, incur the exit load, and feel happy about it. And that return is much more than what he would have earned on his fixed income investments.
Well, I have this question for you. Of the SIPs that he has running right now, assume that he is willing to keep some of them going, or he's willing to increase that time horizon to 5 or 6 years, maybe even 10 years, if he can keep it for the long term. Of these SIPs, which ones would you like him to hold on to?
No, otherwise he has done a good job. You know, when I look at the fund which he has chosen, except for Reliance Top 200, which has a limited history and it has evolved in a different way, the 4 or 5 funds which he has is just of the kind which I would like a growth investor to have. They have the flexibility, they have the track record, they invest across the market, and they are funds with proven credentials. You know, I think it just matches our growth portfolio. So I would not like him to make changes there.
All right, so Jatin, the advice that you're getting right now is the money that you've put in on the 1st of April, you can hold on to the debt funds. You need to pull out the rest of that money right away. And if the SIPs can be held for the next 5 years or so, then continue investing in them. Of course, get back in touch with us if you have any more questions. Let's take another question. Anjani has written in. Now, he tells us a lot of mutual fund companies have launched multiple yield funds or dual advantage funds. He wants to know how they work and if they're the same as fixed maturity plans. Now, do you recommend that he invests in any of these funds?
No, they are not similar to FMP. I would say that FMP is very different, that it is like a term deposit. It is like a fixed deposit. You get your money locked in for a term, and with a reasonable understanding, and all the money is invested entirely into fixed income. Compared to that, these multiple yield funds, they can be investing as they will be allocating a part of the money mobilized into equity, and that is something, or a part of all the gains realized from the investments can be invested into equity, and that changes the complexion. There are funds which were able to deliver substantially more. There were funds which were barely able to match the fixed income return. So it is that small allocation to equity is entirely a function of how well the equity does. Of course, it's a conservative take, and if you are willing to take chances and if you are not dependent on your investment for income, you can well take that view. If you are very risk averse, then invest 90% into fixed deposit or FMPs and have a clear understanding that 10% of your money is getting into assuming risk and risk of equity. And that way you will be very sure that, okay, good part of it is there. Doing it in a vague way with reasonably high expense, I think it is undesirable.
So in our 5th year on this show, the advice has not changed. The advice remains the same. Invest regularly, diversify your investments, don't get carried away by any of the noise or the buzz you hear in the market. Your idea really and your aim is long-term returns. And the moment you take your eye off the ball, that's when things start getting a little nervous. Dhirendra, thank you so much for spending time with us this week. If you have questions for Dhirendra, write to us. Email ID is at the bottom of your screen. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. On this segment, we're focusing specifically on insurance, term covers in particular. Now, I know we've received a lot of questions from you asking us what is a claim settlement ratio, how does it get calculated, and should you or should you not consider it when you choose your policy? Well, take a look at this quick report explaining to you how a claims ratio works.
The Indian insurance market today has over 47 pure term policies of varied rates. How do you choose? The claim settlement ratio acts like an indicator to whether your insurer can be trusted to honor a claim, especially a death claim, if you are not around for your family. It is a good starting point when narrowing down your choices. So it is important to understand what is a claims ratio. It is a simple proportion of death claims that have been honored out of the total claims that are outstanding with your insurer.
This is therefore representing as closely the moment of truth, which is when you had a claim, when you had an unfortunate event, did the company or the insurer actually honor that policy? So the higher the claims ratio, the better it is by and large. A low claims ratio would mean that for some reason or the other, the insurer actually has sold a lot of policies where the event that triggered a claim was not admissible, which one should be therefore very careful of.
And here's how it is calculated. If your insurer receives 1,000 death claims within one financial year, and let's assume it has paid out 971 claims to the nominee, it is yet to take a decision on 10 claims and has rejected 19 so far. The claim settlement ratio will stand at 97.1%. Any cutoff above 95% should give you a green signal. You can check the information on your insurer's website or IRDA.
Companies themselves have to make public disclosures, and if you go onto their websites, you will be able to, under the public disclosure section, take data for that. Secondly, the IRDA publishes the annual report for the insurance sector, in which there is a table that you can download and read, which actually has the data for all insurance companies.
So do not be lured by the low premium alone. It is important for you to check your company's settlement record too. And here's a list of the top 5 and bottom 5 companies. The data according to IRDA from 2012-13 January says LIC tops the list with a ratio up to 97.73%, followed by ICICI Prudential Life, HDFC Life, SBI Life and Max Life. The bottom of this list has Future Generali, Sri Ram Life, Aegon Religare, Edelweiss Tokyo and DLF Pramerica. So, what are the key factors that play a role in settlement of claims?
The age, of the insurance company itself, and for how long it has been issuing policies, and the rate of growth that it has, because this determines ultimately how many early claims they might have been receiving, the claims coming in within 1 or 2 years. Because that can directly impact on how many claims are being investigated and how many claims are being contested.
So make sure you go through the claims settlement ratio on the IRDA website before you make your choice. As they say, the devil is often in the details.
All right, if you have any questions about what you heard, you can get in touch with us. I've also brought in Anil Sehgal this week to answer some more questions about insurance. Anil, thank you for joining us.
Thank you.
Rishi Gupta has written in. He works as a mechanical engineer in Bangalore. He's 40 years old. He'd like to know which term cover to choose among the various policies available online. There's Aviva iLife, iLife Secure, Max Life online cover, HDFC Click to Protect, and the Tata AIA Raksha Supreme. He wants to know of all of these options right now, which one should he choose? Anil, give us a checklist of how we should choose an online term insurance policy.
Rishi, all the plans that you have selected are good plans, and all the companies are well placed. You can decide on which are the ones that you would prefer to go for, based on A, the price, and B, you could look at some of the customer services data. For example, claims payment ratios and stuff like that. What I would suggest to you is that among these, the three that are well positioned are on price are the Aviva and the Tata AIA plan. The HDFC plan is well positioned or better positioned, if you like, although it is slightly more expensive in terms of the overall claims payment ratios. So have a look at these in that respect and decide.
Our next question comes in from Ajay, who writes in saying he's confused about buying health insurance. Now, he's enrolled his parents for a group insurance policy that's provided by his employer. He also wants to know if he should buy an additional cover for his family that will also get him a tax benefit. Anil, I always think it's a good idea to get an additional cover over and above your employer's insurance, but what's your recommendation for him?
So Ajay, all health insurance policies give you tax benefit under Section 80D. And also, if you are providing health insurance for your parents, then also you have additional benefit under Section 80D of 20,000 rupees that you can avail of. So there is no specific insurance policy that you can take which will give you any different, tax benefits. So whatever policies you have currently, you should simply continue doing that, and you can claim benefit under those plans.
Last question on the show. Maheshwaran has written in. He's been investing in the LIC Market Plus plan from 2008 for a steady pension and good returns on his son's education. He wants to know if this scheme is the ideal way to invest, or should he pull his money out and find another scheme to invest in. His aim is to beat inflation and save towards both of his goals. Anil, what would you recommend he does?
LIC Market Plus plan that you have is a deferred pension plan ULIP. Now, you haven't mentioned the option that you have under this plan, which is it has a life cover or does not have a life cover, and the term of the plan. What I would suggest to you is to take a fund value and a surrender value estimate from LIC and then decide accordingly. What you should also consider is the purpose for which you had taken the plan, which is a steady pension as well as a accumulation that you would need for your son's education. And whether this plan is actually meeting those requirements or not. Based on your happiness with the performance of the plan and the surrender penalties which might apply, you can then decide whether to continue holding it for till maturity, a period in between, or for immediate surrender.
All right, Anil, thank you so much for answering our questions. Remember, if you have questions about insurance, mutual funds, anything to do with your money, write to us. Our email ID is at the bottom of your screen. You can also reach me personally on Twitter. It'll be my pleasure to hear from you. Tune in next week to catch the show. Thanks for watching.